Despite its plunging stock price and fears of declining demand, something big might be on the way for Tesla and its investors, especially in terms of the company's stock price. After a difficult year for Tesla last year, which was marked by a massive stock slide that put shares down nearly 70%, several stock analysts have adjusted earnings, ratings, and price targets for Tesla stock. That was done in response to the global economic decline, as well as concerns about Elon Musk's acquisition of Twitter. However, not everybody believes that things will keep being bad for Tesla stock. In fact, some experts like Edward Jones think that now is the best time to buy more Tesla shares. The investment company recently upgraded its rating on Tesla stock from a hold to a buy, stating that Tesla's position as the leader in EVs gives it a distinct advantage over its competitors. Hey guys, welcome back to Tesla Tomorrow. American financial services firm Edward Jones has upgraded its Tesla buy rating to a buy for the first time. According to him, Tesla's share price does not reflect its long-term growth opportunities, and the automaker's new product launches are going to allow it to take advantage of the expanding EV market. Edward Jones offers wealth management services, retirement and college savings products, stocks, bonds, and mutual funds, amongst other things, for business owners. It serves investment clients in the US and Canada through its branch network of more than 15,000 locations and 19,000 financial advisors. The company currently has relationships with nearly 8 million clients and also has around $1.7 trillion in assets under management worldwide, funding solely on individual investors and small business owners. In 2019, revenue for Edward Jones came in at about $8.5 billion. With more than 15,000 locations in North America, Edward Jones has more branch offices throughout the US than any other brokerage firm in the country, and the company's growth has been extraordinary, and its annual revenue has grown from $16 million in 1977 to more than $12.3 billion today. For a company like this to approve Tesla's stock as a buy, then this is something investors shouldn't take for granted. So why have they changed their rating on Tesla stock? Let's find out, but before we do, if you like this type of content, don't forget to like and subscribe for more information on everything going on with Tesla. In 2021, Edward Jones analyst Jeff Window initiated coverage of Tesla with a hold rating. According to him, Tesla is the clear leader in the global electric vehicle market up to this point. And although the company will face a tidal wave of new competition, its $800 billion market cap at the time was already pricing in a tremendous amount of long-term growth and huge successes in ventures outside of auto sales. He said that he believed the market is pricing in 30 to 40% growth in earnings annually on average over the next decade, and it's going to require successful development and launch of products like autonomous driving, semi-trucks, and low-cost sedans. Window also said at the time that Tesla will only maintain its current valuation if the current global EV market continues to grow rapidly. This was just as years ago, and now the firm seems to have grown even more bullish on Tesla. In a recent note to clients, the company's analysis upgraded Tesla from hold to buy and also added the stock to its focus list, despite economic headwinds that are potentially pressuring Tesla's near-term auto sales. The analysis cited that global regulations on emissions and mileage are driving the growth of EVs, and while competition is rising, it expects Tesla to continue to have a significant presence in global markets. The company analyst Jeff Window admitted that the stock movement this year has been eye-catching. However, the possibility of Tesla maintaining significant market share in EVs, as well as the success of its new business ventures, ultimately depends on investor sentiment. Tesla stock has been under pressure due to concerns about Elon Musk's loss of focus on the car company, as well as his continuous sale of Tesla shares. Although, while addressing this, Window says he's not too worried about his divided attention, as Tesla's senior executive team has the experience to continue running the company on a daily basis. He added that Musk will be needed to set strategic objectives, which is important for the EV maker in the long term when it comes to its growth. According to him, although Tesla's stock price decreased last year due to concerns of slowing economic growth and Musk's time spent managing Twitter, the new year 2023 still presents unique opportunities for Tesla, enough to change the rating of the stock from buy to hold. He wrote, "Programs that have software or ongoing subscriptions, like full self-driving, are especially important for Tesla, as they are expected to be more profitable. Additionally, Tesla is working to improve manufacturing efficiency and reduce costs. Specifically, ongoing design improvements with batteries should reduce the costs and help improve profitability." Window believes that Tesla's new product launches will allow it to take advantage of this expanding market, and that the company's share price does not reflect long-term growth opportunities. However, some other Edward Jones analysis have also said that while Tesla has a solid management team that can execute the current operational programs, Musk stepping away from Twitter is going to greatly benefit Tesla. Tesla will likely continue to dominate the EV market, and seeing that the industry is growing at an incredible rate, it's also going to benefit greatly in terms of sales. ARK Invest CEO Cathie in a recent tweet cited the American car rental company Hertz, which stated that its EV maintenance costs are more than 50% lower than gas-powered cars. And according to her, electric vehicles have more miles traveled and they're rising faster than expected, destroying oil demand. Cathie had previously said that more people will key into EVs, and the demand for oil is expected to drop in the near future. She believes that the EV market is growing at a tremendous rate, and it is becoming evident that more people will use electric cars in the coming years. The Tesla bull also believes that the possible shift to battery-powered automobiles is expected to drive the EV market. The market is expected to grow from $287.36 billion in 2021 to $1,318.22 billion and rising in the year 2028 and above. And this is going to go above that 2020 drop caused by the pandemic. According to the ARK Invest CEO, in 2022 to 2024, well, this is going to be the most optimistic time for electric vehicle sales, as new EV models are going to get launched and government policies are going to be more supportive of them. In similar news, New York recently announced that it's replacing about 925 internal combustion engine vehicles in the government's fleet with almost 1,000 EVs, and it's going to install 350 new chargers in the city. And both expenditures will be funded by federal grants. This is in addition to the $420 million approved for EVs and supporting infrastructure at the end of 2021. There's already a high demand for EVs and more is anticipated in the coming years. So imagine what's going to happen when Tesla releases a cheaper EV, say one that's 20 or 30 grand. If the car company can actually capitalize on this demand, well, that's something that they might actually be doing, and it could have insane effects. With this low-cost electric car, EV buyers are likely going to go for a Tesla over another EV, considering the lower cost and higher efficiency. While speaking on Tesla's new products, Window referred to Tesla's imminent rollout of the Cybertruck in Texas, as well as the potential rollout of a new Model 3 design later this year. He believes that both vehicles are going to contribute to improvements in Tesla's stock market price and its position, and during this year we're going to see more competition in the EV sector. Although Tesla will not be the first company with an electric truck on the market, the Cybertruck is likely to be one of the most anticipated in history, with over 1.5 million registered pre-orders. The semi-truck is also another catalyst that we should look forward to. No doubt Tesla stock is still performing way below expectations, but there's a lot to anticipate, especially since the car company plans to launch a number of new products this year. Window cited in 2021 that one major challenge that Tesla may face in the next decade will be funding its growth efforts. He stated that if funding becomes an issue down the road, then Tesla's growth trajectory could become threatened. However, this was during the time when Tesla did not have an investment grade rating. Things have changed now, and we can expect better results this time. Tesla's new investment grade rating could be another reason why Edward Jones changed its rating on the car company. However, Tesla does maintain significant market share, even as more competitors enter the market. But this is not just about the EVs, it's also about Tesla's new business, including solar energy, insurance, and AV tech. And several other projects are in the works, like the humanoid robot and the robo-taxi. Should investors remain positive about Tesla stock? Let us know down below and let us know what your valuation of Tesla is. And if you want to know more about what Tesla's been up to in the last few days, go ahead and click on this next video on your screen. See you there.